Whoa.
Okay.
All right.
Yeah. Now it's being recorded. So the floor is yours, Said. Again, thank you so much for coming in. I guess I can give a little introduction because some of the folks may not know you or they weren't there when you guys came in to present a few months ago about investment opportunities and how uh, you know planning the future in terms of finances works. So really glad to have you, Said. I guess you can tell us more about your qualifications, but for me, you are the most certified person uh, and expert in taxes, investments, and everything related to finances. Uh, Said actually was really useful for me to go through my finances. We had this offer extended to a couple dozen folks in our community. So some of you may have taken that opportunity. So from my experience, it was really useful. So now I'm really looking forward to hearing more about uh, filing taxes, how to do that, how can we save a little bit of money. Again, thank you so much, Said, for coming in.
Yeah, happy to be here. Thank you for the intro and the kind words. And let's kick it off with agenda. So um, we will focus on the first two sections during the webinar. So section 2 was added last minute. Over the past couple of days, I've been looking at tax implications of receiving a scholarship grant, fellowship grant, and as a student, if you're working on campus, what kind of taxes you pay um, at the federal, state, and local level, but also do you have to declare taxes in your own home country in Kazakhstan, and how that works, and are you eligible for credits if you're already paying taxes in the US? That will be an interesting discussion. So section 2 is very new to me, but I did my best to kind of address some of the questions we might have during this call. And section 3 will update you on recent tax laws. In 2025, the Congress and the president passed and signed the new tax bill. It's called One Big Beautiful Bill and has a lot of implications on 2025 taxes. For a lot of households, not just upper class, but also for a lot of middle class families, they will be financially impacted by the tax law changes in that 2025 tax bill. Um, Time allowing, we will also cover long-term tax planning, but if not, we can always do a session later this year if you'd like. Um, and with that, yeah, we can quickly kind of cover this slide. So um, my name is Said Israilov. I'm a certified financial planner. I'm a co-founder of a boutique wealth advisory firm in San Francisco. My co-founder, Max, he's a chartered financial analyst, CFA. He is not here with us today, but from time to time, we come in as a guest speakers with KAPNA community and talk about different topics from investment planning, retirement planning, to tax planning. So um, from my side, I specialize in retirement tax planning and financial planning. On the investment management and portfolio creation side, Max um, kind focuses on those areas. So we have highly complementary skill set. With that, we can kick it off to section 1. So we often get questions from prospects and clients on how taxes work. And uh, in this slide, we try to kind of make a very simplified visuals on how it works, beginning with gross income all the way to taxes payable. So gross income includes all sources of income from your W-2 income. If you have a side gig, um, you'll receive 1099 or you have to file 1099 on your own. That would be a source of income. If you have savings in a bank account, in a high yield savings account, let's say, and you're generating interest, that would be counted as a gross income. Um, So that's the biggest bucket where you have to aggregate all sources of income for you and your household. Next in line is to adjust for certain contributions. Let's say you made any HSA, IRA contributions, or 401k contributions. You subtract those contributions against your gross income to get to adjusted gross income. So we will use this AGI abbreviation very frequently throughout this webinar. So AGI stands for adjusted gross income. It's distinct from gross income. If you didn't, if if you didn't make any, HSA, 401k, or IRA contributions, deductible ones, your gross income will effectively equal to your AGI. To get to taxable income from AGI, you subtract deductions. So you have two options. You either can take a standard deduction, or you can itemize your deductions. For 90%, I want to say 95% of taxpayers in the US use standard deduction just because it's much more beneficial for them. For some households who own a home, let's say, or they have huge state or local income taxes, they try to use itemized deduction. That gets them a bigger deduction amount so that they can minimize their taxable income. It's a little bit nuanced topic. Hopefully, we will cover that in section 3. So because of the 2025 tax law changes, a lot of households in the US are thinking about using itemized deduction. And we will cover that during section 3. So once you get to your taxable income, you're taxed at your marginal tax rate. It is distinct from effective tax rate. So let's say you have a $100,000 taxable income. You will look at the marginal tax brackets to figure out your taxes payable. Let's do a practical example on the next page. So let's say you earned $120,000 in 2025. You made some HSA and IRA deductible contributions. Let's say those add up to $10,000. So your AGI, your adjusted gross income, is effectively $110,000. So 120K subtracting 10,000 gets you to your AGI of $110,000. To keep this example simple, we use a standard deduction of $15,000. So assuming you're filing single, let's say in this case, if you're filing as a married couple, this deduction is higher, roughly double this amount. But for the sake of this example, let's say you are single, so you're eligible for $15,000 standard deduction. So from AGI, you get to taxable income. So $110,000 minus 15, that minimizes your AGI to a $95,000 taxable income. What's interesting here is your marginal tax rate. So the way it works is the $95,000 brings you to a maximum marginal tax rate of 22%. So in the US, you have progressive tax system, meaning as you start making more, you start paying more. Let's say your taxable income is $95,000. The first 10% of your income, so in this case, it's $12,000, is taxed at 10%. I'm sorry, I should have been clear. The first 12,000 is taxed at 10%. The next $35,000 is taxed at 12%. And the remaining $48,000 of that 95 is taxed at 22%. That's a maximum marginal tax rate applies to your income. In this case, it's $16,000. It's interesting because it's this marginal tax rate of 22% is distinct from effective tax rate. In this case, it's 13%. So the way you calculate your effective tax rate is you take your income tax. So in this case, it's 16,000 divided by gross income. So your effective tax rate is 13%, right? But your marginal tax rate is 22%. So you will often hear these tax rates used. So it's important to clarify those distinctions in this example. Again, if you have any questions, feel free to drop in the chat. We can definitely address them. as they come through. Um, so hopefully this visual was extremely simple. Like I can make it super complicated, but this is as simple as it gets. So
It
um,
is really helpful, Said. So I actually figured out the deductions earlier this year. So it's been, was it 8 years in the US, and this is the first time I actually, properly read up about it, and now I understand what it is. So it is basically kind of like a discount that you get, right, on the potentially taxable income, right? So if it wasn't for this deduction, my taxable income would be 110K, right? And
exactly.
of course, which means, I would end up paying more in the end, so that taxes payable would be a higher number. Uh, so just wanted to get a, clarification on that, kind of sharing my understanding of it in a slightly differently phrased way.
Yeah, yeah, absolutely. Yeah, um, as an immigrant, you just face with a lot of tough decisions, and taxes is one of them. But it's kind of boring, and it just kind of delayed, and it's not a priority at sometimes. But once you have a full time job, you start paying attention. I guess a spoiler alert here is if you're married filing jointly, this deduction is bigger. So to make this example simple, we just use 15,000. But if you're married filing jointly, it's double that deduction. And if you own a home and paying mortgage, it's even better. If you're paying a lot in state and local income taxes, you can deduct some of those. If you have medical expenses and so on, it can get really complicated. But this is as simple as it gets. So um, with that, we can move on to.
But Sayed, do I understand it correctly? There is not actually a difference. So let's say like I'm filing a single and it's gonna be 15,000 for me. But if I'm filing as a joint couple, it's gonna be 30,000 per couple, right? So it's 15,000 per individual either way.
Pretty much, exactly.
Mm.
Exactly.
Okay, thanks.
So
Uh,
yeah, go ahead. Yeah.
I was going to say, but it comes in handy, right? So if one of the members of the family is actually earning more than the other one, uh, so like, for example, in a couple, it's not like both people earn like 50-50, right? But in terms of the deduction, you are actually getting 50-50, right? So your deductible, deductible, well, your deductions basically double, even though your family income might not be actually a double of what one of the family members earns.
Exactly. You're reading my mind. That's exactly the point. So if you're a household filing together, if one party makes less, they can definitely benefit from that deduction. Um, yes. Yeah, that's one of the reasons I, enjoy presenting to a community of graduate students and PhDs. Like these topics can get complicated, but you guys absorb this challenging topics very quick. So, um, yeah. All right. So let's talk about timing. So today is end of February. So in starting January, your IRS have been mailed out. So between January 12th and January 31st is when your employer starts sending out your W-2 forms. So if you're employed in 2025 and you are working on campus as a teaching assistant or a research fellow, you are making income, and you will have you'll be issued a W-2 form. And W-2 form will show how much you made, how much taxes you paid in federal, state, and local income taxes. So I would definitely, if you haven't received it, I would definitely reach out to your employer or check your inbox. Maybe it's in there. But um, in January, IRS started processing returns. So as of January 26th, it's open. You can file your taxes. And if you are expecting to receive some money back, you should definitely kick the process today. In February, a lot of the investment brokerage financial services firms will send out 1099 forms. So if you had high yield savings account or certificate of deposit, you will get 1099 INT. If you own stock and you were paid dividends, you will get 1099 div. But if you sold stocks either at a gain or a loss, you will get 1099B. So by February 17, you should have received either electronic copy or a paper copy of these 1099 forms. They are important because in this case, interest and dividends would count as a gross income, right? Like we talked before. If you sold some shares, let's say in Apple, and you generated gain, it's a taxable capital gain. You have to pay taxes on that. But if you sold Apple at a loss, you can use it against your to net against your gains. So I would definitely check if you received this 1099 forms and begin preparation to file your taxes. And obviously, the most important deadline on this page is April 15. That's a deadline when you have to file your taxes. It's not a deadline to pay, but at least you must file your taxes by April 15. It's also a deadline for to make last minute contributions to your IRA and HSA for 2025, not 2026, 2025. So let's say last year you just didn't get a chance to contribute to HSA or IRA. There's still time by April 15 to make those contributions. So we'll
Said,
talk. Yep, go ahead.
do we get a 1099 per account or per broker?
Per account, you'll get per account. So let's say you had multiple brokerage accounts with Schwab, you'll get, for each account, you'll get forms. So the interesting thing is, yeah, you'll get one form. So let's say you have a taxable brokerage account where you have stocks that will be capital gain taxes, but you also have some bonds in that account. So you receive some interest from those corporate bonds, let's say. It will all be reported in one PDF. And you have, let's say, savings account with your local credit union, uh, where you've been saving your emergency savings, let's say, you will have a separate PDF. So each institution will send you their own forms,
But
and
what
you
if,
respond.
for example, you have multiple accounts within one institution?
Mm-hmm.
Like, let's say,
No,
like my individual brokerage account and 401k.
yeah, that's a good question. So, for instance, I have seven different investment accounts with Schwab. I got 7 different PDFs. Um,
Okay.
I had some CDs, I had some taxable gain, some taxable losses. So I will have 7 different PDFs, um, and I'm used to it because I've been doing it for quite some time, and it can get a little bit overwhelming, but it is what it is. So
Okay.
what else? So before we move on, just wanted to say that April 15th is a deadline. You should at least file your taxes by then, even if you owe some taxes. That's an important deadline because you'll be if you fail to file by April 15, and you owe some amount of taxes, you'll be hit with penalties for failing to file. You Let's say if you need more time, I'll always ask for extension. You you tell IRS, hey, you need to find a CPA, or I need to gather my documents and I need an extension. You can delay it up to October 15th, but you should definitely do that ahead of that deadline. Um, I think that's pretty much it. So you still have 1.5 months ahead of that deadline. So, all right. Yeah. So on this page, we have 3 distinct penalties that you potentially face if you miss a deadline and if you don't pay taxes on time. The first biggest one is failure to file penalty, and that's the most common one. People miss the deadline, or their CPAs miss the deadline, and for some reason they drop the ball. You'll be hit with this penalty. It's 5% of unpaid taxes per month. It's capped at 25%. So during that 5 months, IRS will apply 5% penalty. And it stops after 5 months, obviously. And the next penalty is failure to pay. It is lower percentage in terms of like unpaid taxes. So it's at 0.5% unpaid taxes per month. But the downside is it extends to 50 months. So in worst case, if you keep failing to pay, it accumulates for 50 months. So it maxes out at 25%. It's rare that happens, but the first one is more common. Interest charges is addition to number 1 and 2. It's 8% per year, compounded daily, and applies to unpaid taxes plus penalties. And it runs indefinitely until you pay off your credit and penalties. So again, just to emphasize, you need to file your taxes by April 15 and ideally pay it off as soon as possible. Worst case, you ask for extension. With that, we can do a practical example on the next page. Let's say you owe $10,000 to IRS because let's say you sold a bunch of Apple shares at a gain, but you don't want to pay, not don't want to pay, but for some reason you failed to pay $10,000. You failed to file your taxes by April 15, right? That's a penalty. And let's say you woke up in July 15 and you decide to file on that day. So it's been 3 months since April 15. You would be paying penalty on failure to file. So 5% on $10,000 times 3 months adds up to $1,500. So that's extremely costly, as you can see. And you ultimately pay that $10,000 by October 15, 6 months later after the deadline. The penalty on that adds up to $300. Not too bad. But the third penalty is interest charges. So at 8%, you're looking at $448. So you're paying across this three distinct penalties $2,248, 22% penalty. This is a very simplified example. This is super extreme, as you can see, but just to illustrate the point, it's super costly not to file, not to pay. So I guess in this case, at least you want to file your taxes. You might owe some money, but you just want to let IRS know that, hey, I know that I have to pay, but at least I'm acknowledging this, right? All right. So some of you might be filing on your own and using one of the online services. I think there are dozens of online services available, and we did a deep dive on each of those, and we selected 5 out of those online tax filing services, and they come in different shapes and forms. And on this page, we outlined the key qualities for each in terms of like fees and user experience and can they handle complicated tax scenarios. The first 2 you can see are free. So Free Tax USA and Cash App by Square, they are free at a federal level. And for this Free Tax USA, you would have to pay $15 to file your state taxes. With Cash App, it's all free across the board. But they are somewhat limited in terms of handling more complicated tax scenarios. For instance, if you want to deduct mortgage interest, it might be a little more complicated to do that with those 2 options. I personally use TurboTax. I've been using it since, I don't know, 2010, 11. By far, it's the best one out there. It's definitely the most expensive one. I usually pay $80 for federal taxes and another $60 for state taxes. But it takes care of a lot of stuff that I have on my investment side, on my income side. So, I get 17 to 20 different PDF documents from my investment accounts. TurboTax does a good job integrating those electronic copies as a part of my tax filing process. In terms of user experience, it makes it super easy for me to audit step by step what I'm paying for, and TurboTax also does a good job in handling more complicated tax scenarios. For instance, a household with children and mortgage, paying a lot in state local taxes. TurboTax can definitely handle those complicated scenarios. They also offer CPA assistance up to 30 minutes, I believe. So if you get stuck, you can always reach out to their CPA and ask for help. I think
I
that's
think
pretty much.
here I just want to add that if you are not a resident for tax purposes, your university probably provides you with a free service of Spring Tax, which is very similar to TurboTax, but it's going to be free because university pays for it. Just so you know, but but I think it only works if you're not a resident for tax purposes. But if you lived in the US for more than 5 years, you're probably a resident for tax purposes. And I think these options will be relevant for you.
Interesting. Yeah. That's if you have that option, a free option, you should definitely use it as a student. Thank you for bringing that up.
And for that, idea of becoming, or not idea, like for the fact of becoming a resident for tax purposes, we said 5 years. And as far as I understand, it doesn't matter on which day during the year you became the 5 year mark hits, right? So for me, I think it happened in August. Was it like 2022 or 23? But basically, for all the income during that year, I was counted as being a resident for tax purposes, not just those 6 months after August. Is that your understanding as well, Said?
I'm not sure. Like 5 years, so you paid, so if you 5 years to become a tax resident, like at the federal level, like.
I don't think it's exactly 5 years. I think it's actually counted in days, but I don't remember the exact number. I just remember that roughly it is equal to 5 years. I think it's five. It's number of days of your presence in the U.S. or your employment in the U.S. Probably presence. Yeah, and what Aniar is saying is that, like, let's say like 5 years since you entered the US happened like in July. Uh, it doesn't mean that for 6 months you're considered as a non-resident, and for another 6 months you're considered as a resident. You're considered as a resident for the entire year. So
Yeah.
it might be good for folks who are in this call just to count how many days you have spent in the US to check if you are resident or non-resident for tax purposes.
And I think it
Yeah.
has a minimum. It's like, if you spend 180 days per year, then it counts as if, you spent the whole year in the country. And
Yeah.
regardless of when you hit that mark, you basically become a resident for tax purposes for the whole year. So there is no split up in the middle of the year.
Exactly. So I think the day was like 183 days of continued presence in the U.S. You're a kind of at least on a temporary basis, you're a resident, and if you're earning income, you have to file taxes. So if you're a student, that's one semester, right? So you begin your semester in August or September, and up to January and February, you're still employed, yeah, you're on the hook for taxes. Just to be on the safe side, you should always file for taxes. Um, uh, if you have assistants at school, you should definitely reach out to them if they have any free sessions or online tools that you can use. Um, all right. So just before this call, I was looking at distinction between scholarships and fellowship grants. They are very similar in a sense that they're tied to educational institution, but there are slight differences. So scholarship is awarded to a student as long as they are attending accredited institution on a full-time basis for purpose of study. Fellowship grants are slightly different. So they are paid for the benefit of a student, but they are studying for a specific uh, research area. Um, Typically, they are at a higher academic level, meaning like they are either grad students or PhDs. But other than that, fellowship grants and scholarships for tax purposes are treated in a similar way. So, because I was thinking, like, are they taxed at different level or differently? But from my research, I saw that scholarships and fellowship grants are almost indistinguishable. So,
So what part of the fellowship or scholarship is taxable and what is not?
good question. So, if you can go to the next page, so the tax-free part is the scholarship you used for tuition expenses only. If it also includes enrollment fees, required books, supplies, but it does not include room and board. So if you receive the scholarship and 80% of that covers tuition fees, but 20% covers cafeteria, room and board, the 20% will be taxed. The 80% will not be taxed because it's used purely for tuition purposes. So they call it incidental expenses. So room and board, travel, optional equipment, cafeteria would be one. So that would be taxable, right, from scholarship and fellowship grants. But if on top of your scholarship or fellowship grant, let's say you're employed on campus working, let's say 20 hours per week as a teaching assistant, or you could be, working at a cafeteria, making some income, that will be taxed, obviously, because you're generating income. In the university is paying, withholding federal and state local taxes for you, so you'll be getting W-2 form for that. So 1098T, it's a form that you will receive if you receive the scholarship or fellowship grant. It looks like this. I did my best to draw it out here. It's not perfect, but you want to look at two boxes. So box 1 reports tuition and fees paid, and box 5 reports scholarships and grants received. In that statement, so these two boxes are important. So if the amount in box 5 is larger than in the amount in box 1, the difference is generally taxable and must be reported as income. So what it's telling us is you received a huge amount of scholarship, let's say 50,000 per year, but 80% of it was used for tuition and 20% for dorm room. So the part you paid for dorm room will be taxable. The part you used the scholarship for tuition will not be taxable.
I would say that since most of us here are PhDs or PhD students, we usually get fellowships, and fellowships are usually pure like incidental expenses. They fellowships usually don't cover tuition.
Hmm.
So just to clarify here, so probably your whole fellowship is taxable. But the thing is that universities do not withhold taxes across the year. So you probably get the full amount. But keep in mind that at the end, you will need to pay taxes on that. Although university does not withhold taxes within the year.
Interesting. Yeah, if that's the case, you should definitely, keep some cash to pay taxes on that.
Yeah,
Incidental.
exactly.
Okay, that's good to know.
But does it depend on like the treaties between countries, or like which year of the program you are in? Because I think if you're like first or second year, you don't pay taxes, right? And then if there is a treaty, you may not be paying taxes either, right?
Like tax treaties between two countries.
Yep.
I haven't seen that to be the case. We can kind of touch on those treaties in the next few slides, but I think you're still on the hook for the incidental expenses.
There's
Yeah.
a question from Asil.
Oh, I want to mention that in my first year, I got a fellowship, but I didn't pay because I think between Kazakhstan and USA, if you get fellowship, it's non taxable within first 5 years.
Oh, okay.
Yeah.
Good to know. So that's great. In that case, you can, to an extent, disregard page 14. That's awesome. I didn't know that existed. So, 1098 form. So this is what it looks like. I guess it's not relevant anymore if you have the tax treaty for the 5 years.
Yeah,
I guess
but many of us are here for more than 5 years. So we still have to pay taxes because this treaty doesn't work anymore.
I see. Interesting. Okay. Well,
Yeah, and I think that kind of coincides with that 5-year tax residency limit, right? So you have the treaty for 5 years, you're not considered a resident for tax purposes, but then that 5-year mark hits, and then you are suddenly a resident and on the hook to pay taxes, basically on almost everything.
is it a specific tax treaty between two countries, or is this just US does it for all?
Yeah, I think it's specific for Kazakhstan.
Oh,
But
okay.
there is a list of countries for treaty.
I see.
Kazakhstan is not a single one.
Uh-huh. Interesting. Okay. Great. That's a great news then. Yeah, if you, so I guess you have 5 years to figure that out. Well, you're safe for 5 years, but after that, you would have to be taxed on any incidental expenses. But 5 years should be give enough to go to grad school or PhD program, right?
Only in case you have a fellowship. So if you don't have a fellowship, if you're still RA or TA, you still pay taxes even if it's less than 5 years. But if you have a fellowship, then it's not taxable for 5 years.
Gotcha. That makes sense. So if you go to the next page, W-2 form, right? So if you're a teaching assistant or, working at a cafeteria or a library, making some income, you would have to declare taxes and pay, or at least file your taxes, right? So you'll get a W-2 form from your university. So it will have, this is just an example I found, a template online, but there will be your address, university address. On the right hand side, they will detail your earnings, taxes that the university withheld at the federal level, state, and local level. So when you start filing taxes, you'll need this W-2 form. If you haven't received it, you can probably reach out to the university and get this electronic copy. All right. So
There
I did
is a
some research.
there is
Go
a
ahead.
question in the chat, but maybe you have a slide later that will cover the credits,
Mm-hmm.
the tax
Yeah,
credits. Yeah? Do you have
absolutely.
a slide later? Okay.
Section 3 is about deductions, credits, and all that good stuff. So,
Okay, cool.
um, so yeah, this is a very preliminary research about paying taxes in Kazakhstan. So let's say you made $10,000 working in the U.S. as a college student, and you pay taxes in the U.S., federal, state, and local taxes. Do you have to report that $10,000 in Kazakhstan? And the answer is depends. So it depends on um, the big question is, are you a tax resident in Kazakhstan? And based on my reading, it depends on two criterias. So there's a lot of text here, but if you go to next page, I try to distill all this text into this version. So if you meet one of these two criteria, you are a technically tax resident in Kazakhstan. So one is you have strong ties to Kazakhstan. So you have citizenship, a family living there, or have some property like a house on your name. Criteria two is you lived 183 consecutive days within a year. You would be qualified as a tax resident in Kazakhstan, and which means you have to file your taxes. The deadline I saw was September 15, so Form 270, and you have to pay taxes within 10 days after that. They have Kazakh government has 10% flat tax rate on earned income. So let's say you made $10,000 in the U.S., you would declare that income and pay 10% of that. But the good thing is there's a tax relief, so you're not double taxed. If um, if you can go back, go to the next page. So if you pay taxes in the U.S. at the federal, state, local taxes, and if those taxes add up to 10% or more, you can still file taxes in Kazakhstan and tell them like you paid in the US federal and local taxes that added up to more than 10%. That will waive that 10% in Kazakhstan, essentially. So that's foreign tax relief in the tax code. So you would need to submit, I guess, translated versions of your tax return.
Yeah,
So
about the requirements in Kazakhstan, these are actually, Form 270. These are pretty new things. We had someone, the accountant from Kazakhstan, come in and speak to us back in September, because that September 15th deadline was approaching and everyone had questions. And after having that session, we still had lots of questions to be answered. I think it's still the case. People are trying to figure out how it works. So no wonder that it was hard for you too. So we can definitely proceed to the next section.
okay. Yeah, we should do that. I have a quick disclaimer. Yeah, the taxes, the trying to figure out the taxes in Kazakhstan was a little challenging, like double taxation, and are you relieved from it if you're paying in the US? And so you should definitely talk to qualified tax professional in Kazakhstan who knows local laws and tax policies. So yeah. All right. We can kick off section 3. So in section 3, we'll talk about tax deductions, tax credits, new updates from 2025. Before we kick off, as a kind of a trivia information, like a general knowledge information is every 5 years, we have new tax laws passed by Congress. President signs it and it becomes a law. Every president, they have their cornerstone tax bill. starting with Obama to Trump's first administration to Biden's and Trump's new administration. There's been, major tax laws, and over the past 15 years, they shaped the tax landscape, not just for businesses, but also for a lot of us, for households. So today's discussion will be focused on OBA. It's abbreviation for One Big Beautiful Bill Act. It was passed in July 2025. So during his first administration, Trump signed a bill called TCJA. It was a really big one in terms of like tax changes. And the new bill, OBA, is essentially an updated version of TCJA, Tax Cuts and Jobs Act. So in next page, essentially, today's new laws are updated version of the TCJA. Some of the tax laws passed in TCJA became permanent in OBA because they were set to expire at the end of 2025. But once Congress and President signed this new law, OBA, it made a lot of the policies in TCJA permanent. They won't expire unless Congress comes in and changes them. So we'll be talking today more about OBA. So yeah, it's an interesting abbreviation. But very briefly about this tax law, signed in July. I think it was passed in Congress in June and signed into law in July 4th, 2025. It has a lot of tax provisions for households and businesses. It will, in theory, it will supposed to cut about $4.5 trillion in tax cuts over the next 10 years, boost the GDP, boost the investment activity. Today we'll be talking about household benefits, how it helps us, potential benefits us. So we'll be talking about new tax deductions, new tax credits, and updated tax brackets and tax rates. On the downside, it will cost us, it will project it to cost us $3 trillion in national debt. So it's not free because, if you are not collecting taxes, it's going to cost you. So IRS will not be collecting those taxes from businesses and households. So it will add to national debt about $3 trillion. All right. So we can.
Yeah, it's a drop in the ocean, right?
Yep. Relatively speaking, yep. Okay, so credits and deductions. So a lot of people get confused between the difference between credits and deductions, but they are quite different. So deductions, they reduce your taxable income, right? So we saw that you have either standard deduction or you have an itemized deduction. So let's say you have $100,000 in AGI, adjusted gross income, and you're eligible for $15,000 deduction. So that reduces your taxable income dollar for dollar. But based on the taxable income, IRS decides your marginal tax rate. So it is not reducing your taxes paid dollar for dollar. You still have to pay your marginal tax rate. But the tax credits reduce your taxable income. I'm sorry, reduces your taxes paid dollar for dollar. So credits are more powerful than deductions. So let's say you get, just to keep this example simple, $1,000 deduction has less weight than $1,000 tax credit. Any questions? Yeah, this is a little tricky. Like, let's say,
What is tax credit?
So tax credit, for instance, and the most common one in the US is child tax credit. If you have a kid, you can you can take a child tax credit up to $2,000. Let's say you owe $5,000 in taxes this year. you can apply the tax credit to your taxes to be paid and reduce your tax to be paid by $3,000. So your tax is, let's say, $5,000. You're eligible for $2,000 tax credit. It reduces your taxes dollar for dollar by $2,000.
For
But
one
let's say
child?
for one child. But let's say you don't owe any taxes, right? You paid your taxes. Your employer withheld your taxes enough that this year you all good to go. You just file your taxes, but you still have a kid. And what happens to this tax credit is it's fully refundable. The $2,000 comes.
Wow.
Yeah, it's called child tax credit is unique in a sense that it's fully refundable, even though you don't owe any taxes. Some credits are not like that. So if you don't owe
Mm.
any taxes, they won't give it to you. Um,
I think
hopefully,
Yelbur chat asked about learner credit in the chat.
let's see. But we can use lifetime. Yeah, yeah, yeah. So lifetime. Yeah, there is a credit of like I forget the amount. Like maybe it's $1,000. But um, as an international student, you're not eligible, as far as I believe. You have to be a resident for that.
But last year I claimed it because I Googled. Google said I can as a resident for tax purposes. But this year I Googled again, and different sources still say different things. So I'm very confused.
You can only claim it once. That's for sure. Like it's a lifetime credit. Like you can't be, claiming it every year just once. But even
Oh,
then, Mhm.
I was gonna say, Yelbur, you got yours.
I did not know it's a one-time thing. Interesting. I mean, I did it only once, but no. Okay.
Good question. Yeah. So lifetime credit can be used only once. Yeah.
It's
And
kind of confusing, right? Like it says lifelong learner credit or like lifetime credit. So you would think that it would apply, until the end of the life.
yeah, I'm just looking at it. It's a $2,000 non-refundable tax credit for students, undergrads, grad, PhDs, and so on. You can only use it once, and but in terms of like claiming it as an international student, I'm not sure. Probably you are eligible, but for some reason I thought you had to be for immigration purposes, like what do you call, not an international student. But I might be wrong.
I mean,
Well,
for instance, I filed the 1040 form, not 1040 NR, because as a resident for tax purposes. I'm not like I don't have a green card or anything, but I cannot use the Glacier software, for example, that's often used for international students in universities. Um, and uh, and then I Googled if I, as a resident for tax purposes specifically, can I use that lifelong thing? And in my initial Googling said yes, and that's how I claimed it last year. But now I'm so confused.
How long have you been in the US?
Oh, for a long time, since 2015.
Okay. So it says one of the provisions is if you've been in the US for more than 5 years, either F or J1 student, you may be considered as a resident alien for tax purposes. So you can claim lifetime learning credit. So less than 5 years, no. More than 5 years, yes. So I guess
But I can only claim it once. Are you sure about that?
I
Because
believe so.
Yelbur, yes, just once.
but that actually, like it's bad for me. Like I'm not in school anymore, so should have taken advantage of it while I was studying. But I think that again comes back to the earlier conversation of being a resident for tax purposes. After 5 years, So I think after 5 years, there's basically no difference between us and those who are like born and raised in the US, for example, because we're all tax residents by now.
So I did a quick Google search. So there are like two distinct credits. One is American Opportunity Tax Credit that you can only claim once, but
No,
looks like
IRS website explicitly says lifetime learning credit can be, there is no limit on the number of years you can claim the credit.
yeah. Okay, so I guess there is no limit for lifetime learning credit, unlike the other one, the AOT, the American Opportunity Tax Credit. So you
So
can claim $2,000.
what's the eligibility? You have to be a student for that?
So the IRS website, I'm just reading. Actually, I should. I don't know why I haven't read this before. I was just relying on Google, being lazy, I guess. So eligible students for LLC is be enrolled or taking courses at an eligible educational institution, be taking higher education course or courses to get a degree, or other recognized education credential to get an improved job skills. I mean, you all can use the link. So that's, yeah, it's different from interesting.
Oh, I guess like if I was a student for like 5 months in 2025, I could still use it, right?
Good question. I can't certainly say that, but it's worth a try. If you're using TurboTax, you should definitely check if that's an option. Yeah, I'm not super familiar with educational tax credits, unfortunately, but I'm surprised you can use it every year. But if you're eligible, you should definitely use it, especially if it's refundable, regardless if you owe taxes or not.
Yeah, that would be so great because I mean, PhD students are so broke. At
Yeah.
least one thing is towards the benefits.
Yeah, when I used it last year, if I didn't use it, I would have to pay IRS. But as soon as I claim it, they owe me money. So I was very excited about this credit.
Mm-hmm.
Thank you for the link, Yelber. Looks like there is also an interactive education credit app where you can basically answer some questions and see if you're eligible for education credits.
Yeah.
So we talked about child credits and we talked about this educational credits. Are there any other credits that we should be aware of?
Yeah, so if you can scroll to page 27, we can skip deductions for now. So you have child tax credit. So it went up this in 2025. So it used to be $2,000. Now it's at $2,200. $1,700 is refundable. So that portion is refundable regardless if you owe taxes or not. You'll still get that check. There's an adoption credit that expanded quite a bit. So there was an increase of $470 in adoption credits. MAGA accounts are new. It's you probably heard like if you it was also passed last year as part of OBA. But essentially, if you have a child born between January 1, 2025 and December 31st, 2028, you can open a MAGA account and the government will deposit $1,000 and it has some tax advantages in it. So that's one of the new provisions we saw from the government. So they will essentially credit you the $1,000 if you they'll match $1,000 if you deposit some amount in that child savings account. Those are the biggest tax credits available. In terms of deductions, maybe they're not dollar for dollar attractive. So on page 26, in 2025, so part of the new tax law, standard deduction went up. So as a single individual, you can, for 2025, you have a deduction of $15,750. So that's a $750 increase. That's why a lot of tax filers use standard deduction instead of itemizing it. Another big change came through last year was SALT deduction. So SALT stands for state and local taxes. The cap used to be $10,000. Now the cap is at $40,000. So imagine you're filing single and you're eligible for $15,000 standard deduction, but you pay $20,000 in state and local taxes. Now it makes sense to itemize your taxes and take that SALT deduction over the standard deduction. Because again, just to reiterate, you have two options when you file taxes. You either take standard one or you itemize it.
Said, can you
Historically,
explain what is itemized deduction? I
yeah.
understand what the standard is, but still confused about itemized.
So I guess we can skip forward to page 30. That could be a good page to show this, how it works. So um, if you have significant deductible expenses in a tax year, you add them up. So it could be healthcare expenses, it could be mortgage expense, mortgage interest, it could be, sorry, if you go, can you go to page 31? 31, the next one.
I can't see the pages, so like if you
Oh,
tell me, like,
okay. Oh, sorry. Yeah, if you go and go next page. So, in the US, you have um, two ways to item. You have two options in terms of the deductions. You can take either standard or itemized. So people itemize their deductions instead of taking standard. So standard is uniform across all income levels and households, right? So if you're single, you're eligible for 15,000. If you're married, file jointly, you can claim $31,000 in deductions. But some families can do better in terms of deductions if they itemize. Itemize means you show IRS all your receipts for expenses and you claim that my itemized deduction, if I add them up, they're more than, let's say, 31,500 and they are at, let's say, 40,000. That gives you a higher deduction, and in return you can minimize your taxable income, right? A lot of the things you can itemize is your SALT, state and local taxes. So if you live in New York or California, you are living in a high tax state, you're probably paying a lot in state and local taxes, so you can itemize up to $40,000. If you have a mortgage, you're paying interest, and you bought it very recently, most likely you're paying a lot in monthly mortgage interest. That counts as that's one of the items you can itemize. If you made any charitable contributions or you had significant medical expenses in a tax year, those would be the things you want to add them up and see, are they more than 31,500 for married couples or more than 15,000 if you're filing single. So that's a tricky thing, right? You have to show the receipts, you have to show the IRS that you've been paying these expenses, medical, mortgage interest, you made some donations, you paid a lot in state and local taxes. If that's the case, you should definitely itemize your taxes versus taking standard deduction because it reduces your taxable income dollar for dollar. I'll pause here and maybe a prior page could also add some value. So again, a decision to itemize or take standard deduction depends on, do you have a lot significant items to itemize? So things like mortgages and healthcare expenses and so on. If the answer is yes, you should itemize. But if the answer is no, you're not a homeowner, and you live in, I don't know, like in Texas, and you're paying minimal state taxes, you don't have significant healthcare expenses that you can itemize, you should use a standard deduction. The challenge with itemized deductions is you have to show the receipts. Like you had significant healthcare expense, you have to show electronic copies. If you have mortgage interest, you have to show your statements. If you make charitable contributions, you have to prove that to IRS. In case you get audited, you have to be ready to show IRS that indeed you claimed $40,000 in deductions, and you have that ready to share. I'll pause here. It's a little complicated, this topic, for a lot of us. So,
Well, in practice, for a lot of us, I guess, who are just out of their PhDs, who are still doing PhDs, standard deductions will always be a much better option, right?
exactly. So if you're a student, standard deduction 99.9% of the time is the way to go. So I guess for your future reference, if you want, in the future you graduate and get a job and get a mortgage, start making a lot of money, paying a lot of state and local taxes, you might be better off itemizing your taxes versus taking the standard deduction. So
there was a question in the chat from Marcel. If you can respond to that.
Let me just take a look real quick. So I came to the US in 2017. I didn't pay taxes for that year, but I did for 2024 and pay taxes. Should I go back for file? If I didn't file. So in 2023, if you had a job, like a on-campus job.
Yes, I was a research assistant from November till this January, like December, 2 months, right? But I filed for federal, and yes, it was okay. I got a refund. But that time I didn't know. I just arrived. I didn't know if I should file for state. But next year I filed for state. But so now I'm still worried about my 2023 years that I didn't file for California tax.
Yeah, interesting.
What should I do? Like, because when I get last year, I really paid 300 for state. I paid them. But when I came first, like for the 2023, I got the refund like around 1,000. I was just surprised. But next year, I had to pay.
So in 23, you filed your federal taxes, but not California taxes, right?
Yes, right.
I would send an email. That's the best thing you could do. Ask for forgiveness if you were, if you had to pay state taxes, then it's better to reach out to them now. Just a quick email. You can promptly find their email, but you should briefly explain.
Like email means like electronic email, or like I should send using UPS, like.
Oh no, electronic email should be sufficient.
Okay, thank you.
Yeah, just for their reference, you probably can attach your 2023 tax form, like federal tax form, and say like, I got a refund because my employer withheld some taxes, and one of the things I failed to do was, file for California taxes. Please help me remedy this situation, this case. So
should you reach out to California tax authorities or federal?
California State Tax Authority. You should reach out to them.
Okay, thank you.
So based on my experience, they'll usually get back to you within 2 to 3 business days. So, but at least you file your federal taxes. It's the IRS that you need to be careful with. Well,
okay.
Yeah, good question. Did you file like paper copy or electronic copy? Like, how did you file your taxes?
A paper copy? Like, because we have a glacier, I print out and signed and sent to them. UPS, yeah.
Gotcha. Okay. Makes sense.
Yeah, that they will probably waive it. I mean, it's California, just for 2 months.
Yeah. So Yelber is saying usually universities, yeah, you should definitely, I guess before you reach out to state tax authority, you should check in with the admission office, not admission office, but someone in the HR or tax office at your university and explain, maybe show up with a paper copy of your 2023 tax return and tell them, even though you filed federal one, but you didn't file state tax, you should check in with them first before you send an email. So, yeah, good question. Great. Yeah, so these are. Can we go to prior page?
Yeah, I can see the page numbers now. So just in the interest of time,
Yeah.
we don't want to keep you for too long. So is there like maybe like a couple other slides, important slides we should look at?
Yeah. So yeah, good. Thank you for reminding me. So so let's end with section 3. So we won't jump into section 4. So instead, maybe we could do yeah, just to recap again, like the question is like, am I better off with standard or itemized deduction? As a university student, most likely you will benefit from standard deduction. So as a single filer, you get 15.5. As a married filing jointly, you get 13.5. So those are big thresholds to cross in terms of like deciding between these two options. So, but for your knowledge later on, if you after you graduate and you get a job and you start pondering, should I itemize my taxes? One thing could help you is kind of add up these expenses: mortgage interest, state and local taxes, medical expenses, and so on. If they add up to more than 31,500, you should itemize your taxes. If not, we can just take the standard deduction. I think if you like, maybe there were a few more pages at the yeah, this one this one, the next one. So this one is interesting. So state and local taxes, just wanted to reiterate. So historically, you could deduct up to $10,000 in state and local taxes, but effective 2025, you can deduct up to $40,000 in SALT deduction. So for a lot of households, especially for single filers, now it makes sense to itemize their taxes. Other than that, auto loan interest might be applicable if you buy a new car in the US. You can deduct interest payments on that, but it has to be a new car made in the US, well, assembled in the US. So I don't know, if you're buying Hyundai assembled in the US, you would be eligible for that deduction, interest deduction. If you're a salaried employee, tips, income, and overtime pay is will not be applicable to you. It's typically applicable to hourly employees. So I think we are good on this page. On the next page, so we covered this page and some bad news. So some tax credits were expired in 2025. So you used to be able to buy Tesla and claim $7,500 in tax credits, or a used Tesla and claim $4,000 in tax credits. So they are all gone. Some of it is kind of political, as you can imagine. So those are the big ones that got eliminated effective 2025. This is an interesting slide. So standard deduction has been going up year over year. So looking back from 2020, you could claim up to $12,000 in standard deduction as a single filer. Now it has grown over time to $15,000 in 2025. It's usually adjusted for inflation, right? The IRS announces at the end of year the increase. So increase this year, last year was substantial. So from 14.5 to 15.5 is a big jump, 8% increase. Usually it's adjusted by 2.5, 3% for inflation, but 2025 is a unique year, so it's up to 8%. Any questions so far?
If there are any questions, guys, feel free to put them in the chat or raise your hand. I think we have time for a couple of questions, and then we can plan to wrap up around 9:30. Or like, what's the time? Yep.
So we have a question in the chat. What would happen if IRS learned that I forgot to disclose having a bank account at home? I'm not saying that I did. I was asking for it. That's a good question. IRS operates in a good faith policy. It's up to a taxpayer to disclose whatever they have. It's a tricky question. If you generated some interest in your savings account with that bank, ideally you want to disclose that as a gross income, right? Crypto transaction. If you had any crypto transactions, let's say, and you had some gains selling those, Coinbase or whatever platform you use, you need to disclose those transactions, any capital gains you made. So with Coinbase account, I get a tax form from them, and I have to upload it in my TurboTax account. So yeah, crypto is taxed. Second major thing is, if you are sending money back home to a family member, let's say it would be a remittance, right? Like you sent $1,000 or $5,000. Effective 2025, it's taxed, so at 1%. So that's a new law that came through with OBA. It's part of a big, beautiful bill. So any amount you send it, you have to declare, you have to pay 1% tax. It's not a big amount, but something to be aware of. Again, to recap, so deadline is April 15th. Gather your documents, W-2 forms, 1099s, like at least electronic copies. If you haven't received those, reach out to those institutions. Start uploading documents on TurboTax or whatever the platform you use. If you still need to catch up on, I don't know, IRA or HSA contributions, you can do so. I think those are the big ones to take away from this meeting.
Perfect. Lots of useful information as always. Said, really appreciate it. Thank you for coming in and answering the questions. And the slides are very beautiful as well. So we'll make sure to share them with the rest of the community, and the recording will be available for them too. Do you want to share your contacts with attendees, or are they on the slides as well, in case people want to reach out?
Hey, thank you for bringing that up. We share, as a wealth advisory firm, I just pasted the link to our Instagram channel, but we share a lot of tax planning, financial planning, investment planning tips. If you can follow us on Instagram, it would mean a lot to us. So we can keep in touch through that. So
that's the least we can do. So just follow you on Instagram, and I already follow you, and the information is always useful. So it's not like you signing up to watch some ads or doom scroll. I promise the information is usually useful.
Appreciate it.
All right. Thank you so much, Said.